Okay, so this is a somewhat unusual event for Bruegel. We are doing this with Robert Triffin International, which is a Belgian society, and international society, European International, dedicated to preserve and boost the economic thinking and the work of Robert Triffin. I think maybe Bernard Snoy will say something about Triffin, but we do have several Triffin experts in the room. Can I give it away at this point, or you want to hold up the book, right? Okay, so you do this. You do this later. Okay, so this is an incredibly interesting figure. This is nerdy stuff. It's stuff related to the functioning of the international monetary and financial system, and it's coming back. So it is gained a huge popularity, prominence, because the so-called Triffin dilemma, which made him important, is a theory that has been recently evoked by the so-called neo-Triffinites to argue why the United States, as the world's leading provider of a reserve currency, might be condemned to running a current account deficit. Now, this thinking is fundamentally wrong. So Triffin's theories do not imply this. And the people who are best positioned to explain this are Hélène Rey and Pierre-Olivier Gourinchas, who have written extensively about this. But we are really in the thicket of a debate, again, that started with Triffin and has now come full circle, just like many other topics that we thought were part of another era, like global imbalances, are coming again full circle because they're fueling essentially geopolitical and economic tensions around of the world. So it is super timely that we do this event, which will touch on some, but not all of this debate. And so with me, I have the two stars of the society. And what I will do now is I will hand over to Bernard, who will introduce the remainder of the speakers and chair the first round. So he's the chairman of Robert Triffin International. We will then have Isabel present. We will have 3 discussions, and then we will have an open discussion with all of you, which I will then chair. Please, Barbara.
Thank you very much. On behalf of Robert Triffin International, I would like to thank very much Dr. Isabel Vansteenkiste for having agreed to deliver this year's Triffin Lecture. And I'd like to thank very much Bruegel for co-organizing today's event in their splendid headquarters. Robert Triffin International was created in 2000 in Louvain-la-Neuve, but with also a strong support coming from Italy, in particular from the Compagnia di San Paolo di Torino. It was created under the chairmanship of Alexandre Lamfalussy, former managing director of the Bank for International Settlements and former president of the European Monetary Institute, to preserve, as Jeromin said, to preserve and promote the intellectual heritage of the Belgian-American economist Robert Triffin, or Robert Triffin. Triffin, as you know, made a number of key contributions to economics, the most famous of which has been mentioned, the Triffin dilemma, which says that when the currency of one particular country is used as the global currency, it is bound to lead to an impasse, to an impossibility due to excessive indebtedness and loss of confidence in that the currency. And that, of course, the interpretation of what the Triffin dilemma is has evolved over time. But Triffin is also among the fathers of the European Payments Union. It is a father of the ECU and of the exchange rate mechanism of the European monetary system. And of course, his dearest child was the special drawing rights. Throughout his life, he advocated a reform of the international monetary system, making it more stable, efficient, and equitable. Ivo Maas, a member of the board of Robert Triffin International, has produced a remarkable biography, which of course I recommend, at Oxford University Press. But we do not limit ourselves to looking to the past. We launched in 2010 the Triffin 21 initiative, aimed at demonstrating the relevance still today of several key proposals of Triffin. In particular, we supported the Palais Royal initiative, which was launched after the great financial crisis by Michel Candessu, Alexandre Lamfalussy, and Tommaso Padoa-Schioppa. It was also in 2010 that we started the tradition of inviting each year a prominent international personality to deliver the Triffin Lecture. The first lecture was given by Tommaso Padoa-Schioppa, who, as you know, had been a member of the executive board of the European Central Bank. That was in 2010. And subsequent personalities who gave Triffin lectures included Lorenzo Binismaghi, another former member of the ECB executive board, Michel Candessu, well known for all of you, José Antonio Ocampo from Colombia, who had been Deputy Secretary General of the United Nations, Marco Butti from DG ECFIN, Jean Lemierre, the former president of the EBRD and the chairman of BNP Paribas, Carlo Monticello, Jacques de la Rosière, and Pierre Gramegna. That was last year. Gramegna is, as you know, the managing director of the European Stability Mechanism. I would like to recall also that Robert Triffin International has launched several task forces, among others, on using the special drawing right as a lever to reform the international monetary system. Another task force was on managing global liquidity as a global public good. We organized a number of conferences, among them 2 years ago, a conference in Louvain-la-Neuve on the obstacles to the financing of the ecological transition linked to the present international monetary system. And another conference last year in Lisbon in cooperation with Banco de Portugal and the Lisbon Academy of Sciences on the theme 8 years after Bretton Woods, relaunching multilateralism through regional monetary unions. We publish regularly new papers, including a recent manifesto and a paper on Trump economics and the Triffin dilemma. All these publications can be found on our website, and I had displayed a number of them on the table, and I'm pleased to see that they have been taken up. Now I have the pleasant role of introducing our lecturer, the Triffin Lecture of this year. In July of this year, the Executive Board of the European Central Bank appointed Isabel Vansteenkiste, who was at that time already Director General International and European Relations, as Principal Counselor to the President and Coordinator of the Council to the Executive Board of the European Central Bank. Dr. Vansteenkiste took up her new role on 15 September. In this role, she advises President Lagarde on a wide range of economic and strategic policy matters and supports preparations for the Executive Board and Governing Council meetings, as well as for high-level international engagements. She also oversees the work of the Council to the Executive Board. Isabel Vansteenkiste has worked at the ECB since 2002. Previously, she held the position of Deputy Director General in the Directorate Monetary Policy and in the Directorate General Economics. In the latter, she was a senior advisor for the preparation of Governing Council meetings and head of the Country Surveillance Division, which assesses Euro area countries' economic policies. She was also the ECB's mission chief to Portugal from 2014 to 2017. Isabel's main fields of research interest are international macroeconomics, applied macroeconomics, and monetary economics. She is also a visiting professor at College of Europe. She holds a PhD in economics from the Katholieke Universiteit Leuven. Now, dear Isabel, it is your turn to deliver your Triffin lecture. Thank you very much.
Thank you very much, Bernard, and thank you for the kind introduction. And thanks a lot to the Robert Triffin Institute for inviting me this year to give this lecture, and to Bruegel for co-hosting and for having us here tonight in their premises. As I work for the ECB, I need to always start with the traditional disclaimer that these views are my own and not those of my institution or for people related to the ECB. But what am I going to talk to you about today? I'm going to ask the question, are global markets heading towards financial fragmentation? And what are the implications for the international role of the euro of the changing global environment? And I thought what better way to start a Triffin lecture than to come with a quote by Robert Triffin himself. I'm now a little bit worried because there's so many people here who most likely know much more about Robert Triffin than me, so I hope I give a good characterization of what he said already back in the 50s and 60s. And I'm not coming with the traditional trilemma quotes, but I come with a different one where he said, the survival of the international monetary system depends on the willingness of nations to cooperate and to recognize the interdependence of their economies. So he said this already in the 50s and 60s, and already back then, basically, he was of the view that economic interdependence was an unavoidable reality. So pure national sovereignty was already illusionary in the monetary domain at that time. And so he actually urged countries to transcend their national self-interests, to go into multilateral policy making and work collectively to safeguard the stability of the international monetary system because it was vulnerable to cross-border shocks. And of course, this then led to his advocacy of what Bernard already was referring to, such as the creation of the SDRs, but also the support for the European monetary integration. So you can wonder if Robert Triffin was saying this already in the 50s and 60s, what he would be telling us today, right? First of all, the world is very integrated today, but we see also a lot of discussions about global cooperation being under threat, right? So you see here the Economist, a new economic order, but you have every day you can find stories about the geoeconomic fragmentation. Is the world heading to a new way, a new equilibrium? Are there multipolar blocks forming? The question is, if you're looking in the 50s and 60s, and he was already saying that back then, how concerned should we be today about global cooperation being under threat? Now, just to illustrate my point that the world is very strongly integrated, this is just a very simple chart looking with a proxy for international financial integration. And basically, it's measuring the sum of the stock of total gross external financial assets and liabilities divided by world GDP. The chart goes back to the 70s, but believe me, if you would go back to the 50s or before, it's at the level that you see more or less in the 70s in terms of integration. So what is clear is that we're basically at a historical high level of integration. It stalled more or less after the global financial crisis, but it remained at very, very high levels. At the same time, this occurs when we're constantly saying also that many challenges are global in nature and we need to cooperate globally to face them. And some of these examples were the pandemic, but also the climate challenges or moving to a more digital age. It's a challenge that we all face and that we ideally face together and in a cooperative manner. Now, despite this integration and these common challenges, actually, fragmentation has already been with us for some time. We hear it much more talked about today, but actually if you look back in time, this occurred already around the time of the 2000s and the global financial crisis. And just to illustrate this here, word counts in printed press. You can all do that. You can just go to Google, go to Ngram Viewer, and you can type in any word and see how frequently it has been quoted in printed press. And if you take this as a proxy for how commonly a topic was basically, or how much alive a topic was over time. So what you can see is multilateral institutions in the post-World War period have been on an increasing trend basically until around the 2000s, right? And that kind of strikes with our view that multilateralism has been on the rise and we engage more and more in multilateral cooperation. But since then, you see multilateral institutions being far less frequently mentioned, and at the same time, the word geopolitical tension starts to arise. If you look on the chart on the left at the international fora, the G7 that was created in the 70s and at the time made a lot of sense because it represented basically the bulk of the economically important nations in the world, lost importance around the global financial crisis, and that reflects that emerging markets became increasingly important economically. And the G20 really stepped up at the time in the global financial crisis, reflecting also this need to integrate the emerging markets. But at the same time, there was a frustration by emerging markets and developing economies that this was going to slow this recognition and not far enough, right? And this led to the creation of alternative fora, such as the BRICS, for instance. But you also had alternative initiatives, such as the Chiang Mai initiative that came to life at that time, already showing some signs of fragmentation. But of course, fragmentation has stepped up massively since Russia's invasion in Ukraine. This is a bit more of a complex chart, so I will talk you through it to understand what it shows. But if you think in 2022, when there was a UN vote for the support of Ukraine's territorial integrity, when there's UN votes, countries can either vote against, they can vote in favor. You can also abstain from voting, so that's when you don't want to take a side or you may be neutral on an issue. And countries can also be absent. That's a very small share. Most of the time, countries just are not able to be at the vote, but it could also be a strategic absence. You just don't show up, and then you don't even need to show that you're abstaining, for instance. Yeah. Now, you take the vote in 2022 in the support of Ukraine's territorial integrity, and you weigh every country's vote by its share in IMF quota, right? So by the IMF's financial contribution. So, of course, the IMF didn't vote on that, and the UN doesn't weigh votes like that, but it's just to give you an illustration of how much agreement was there in the world in 2022 on this issue. So by this kind of metric, you would have said around 80% in the world was voting in favor of supporting Ukraine's territorial integrity. Now, fast forward to 2025, a similar vote was tabled at UN, and what you can see is quite a bit of a different voting outcome. So you have a block of against, which represents 20% of the world in terms of IMF financial contribution. And importantly, of course, the US changed position, right? And that's partly reflecting this here. But you had also a much larger block of countries abstaining. So where you end up is that slightly above 50%, and by this weighting scheme, was still supporting Ukraine's territorial integrity. So what I'm trying to tell you is that basically decision-making by this kind of metric has become much more complex. There's two other bars on the chart on the left and on the right. There's two other bars, and this is just a calculation because at the IMF there's a lot of discussion where the emerging markets are underweighted in their quota shares for the moment. So if you would take what the IMF's own formula would say with the latest data, emerging markets, in particular China, would, for instance, get a higher weight and some other countries. But by and large, the story is the same. You had much more agreement in 2022 than you have today, basically. And of course, that makes decision-making more complicated when you look at multilateral institutions. And this is important because, for instance, when you think of the deployment of a global financial safety net, you need to agree collectively on deploying it and how you're going to use it. I'm showing you here, for instance, on the IMF resources, they have massively increased in the aftermath of the global financial crisis. But what you can see today, the green bar and the light blue bar basically are temporary resources that was agreed upon in the global financial crisis. And of course, they are requiring, for instance, agreements on extensions. I'm not saying that this is necessarily up for discussion today, but of course, in a fragmenting world, it becomes more and more difficult to agree on this. The permanent resources, by contrast of the IMF, and I have here in this next chart, if you look at the green light, the quota resources in percent of world trade, as just a metric of the relativeness to the world's integration have become relatively smaller compared to what you had, for instance, in the 70s. This is not even weighted by the degree of financial integration, which has increased even much more in a way. So IMF resources have, by that metric, actually become smaller compared to basically the size of the needs that may arise. So then my question is, what does this mean for the international monetary system? So for those who leave early, I already put my main messages up front, so I'm not going to surprise you until the end. But what I'm going to try to demonstrate in the lecture is that thus far, international monetary system has actually remained largely immune to geopolitical fragmentation, but we're seeing cracks emerging. In that regard, movements towards geopolitically aligned payment systems could potentially be preceding some broader changes. So the question is here, is this the canary in the coal mine? And I'm really urging those who want to do research, this is really an area I think that is under-researched and that is becoming increasingly relevant. Now, in the long-run trajectory where we're heading towards, will a lot depend on those countries who are the main reserve currency holders today, on how they're going to maintain their economic resilience, their institutional credibility, and uphold the rule of law. If fragmentation arises, in particular if it's from within the West, it could have profound implications. It's in nobody's interest, and nobody will be left unscathed, basically, from that. And finally, if fragmentation really intensifies, you could imagine a world where we have a multipolar currency order. Today, the dollar is dominant, but you could imagine a world where you have many currencies in the international scene. Now, if multipolarity arises because countries have stronger fundamentals and they do better, and for that reason, their currency is more used in the international arena, and then that's a good thing, and it may offer diversification benefits. But if it's founded in fragmentation, it could also carry significant risks. And particularly the transition from a very integrated world to a more fragmented world holds risks, in particular because you may still need to deploy, for instance, instruments such as the global financial safety net, whereas the decision-making to do so may become more difficult. So what does it mean for the international role of the euro? Shifts in the global order could present an opportunity for the euro, but as with everything for Europe, the onus is on Europe itself, and it needs to do its homework. And it will need to reinforce three key pillars for that: strengthen its geopolitical credibility, strengthen its economic resilience, and make sure that it maintains its legal and institutional integrity. And the details on what that means precisely, I will still keep to the end so that at least you don't all leave the room at this point now. So first point, global financial system has remained largely immune to geopolitical fragmentation. So just going to look here at the aggregate data, and this is actually the data I was showing you just before on international fragmentation, financial integration, but now delved into some detailed blocks. So it's splitting basically this data up into a US, China, and then a US block, or a block geopolitically close to the US, a block geopolitically close to China, and then a group of countries that we're putting in the rest of the world. Now, the way that these blocks are set up is basically kind of the industry standard by now. You look at UN voting, and you look basically at countries that tend to vote along with the US are seen as geopolitically close to the US. Those who tend to vote closer to China are geopolitically close to China. And then you have those who are a bit more neutral, who are an in-between block. So what can you see? First of all, US and countries geopolitically close to the US, so the dark blue and the light blue bar, basically still dominate global finance. They account for around 65% of global external assets and liabilities. The share of China and countries geopolitically close to China account for around 2 to 3% only. Yeah. And this is basically very low. And that's even low when you compare it to China's weight in global GDP and trade. So its weight in global GDP of China is by now 15%. Its weight in global trade is around 13%. Now, if we take out financial centers and we lump them basically all in the rest of the world block, that's basically the chart on the right, you see the picture more or less remains the same, but what you can see is a huge rise in the importance of financial centers, which means tracing financial flows has become more difficult. And those represent around 1/3 basically now of global external assets and liabilities. Now, what does that mean in practice? What I'm showing here. So the Western countries still account for the lion's share of global external assets and liabilities. So there's an enduring asymmetry going on there, and it means basically also for emerging markets that they're still substantially dependent on Western financial markets. Cutting them off would be very difficult. By contrast, West cutting itself off from the Chinese and China-related markets is relatively easy from a financial markets point of view. But what is the most risky, as you can see in the charts, is fragmentation from the West within, because the West is extremely interlinked. And this is not necessarily shown directly in the chart, but the linkages between Western countries financially are extremely strong. So a fragmentation within the West would be very difficult and very painful, but it would also be painful for emerging markets given that they're so dependent on Western financial systems still. If you look at other indicators of whether geopolitical fragmentation has an impact on the international monetary system, the most traditional indicator we look at is the use in global foreign exchange reserve or certain currencies. And there basically we see quite some inertia. For instance, the euro has remained largely stable and represents around 20% of the share in global exchange rate reserve baskets. We've seen the dollar decline. It was around 75% in 1999. It's around 57% today. And we've seen a rise of third currencies. But this is mainly explained by economic factors. These are countries like currencies like the Swedish krona or the Australian dollar. And the reason is that they have become more liquid. Their assets have become higher quality in many cases, and so investors want to hold them, and actually for good reasons. And the decline of the dollar in foreign exchange reserves is actually more than offset by increases in other indicators of international use of the dollar. For instance, international bond issuance, the dollar has continued to rise in importance. So if you take all the indicators that we can look at to measure the international use of currencies, and we lump them together in an unweighted average, then you see the snapshot on the right of the importance of international major currencies. You can see the dollar is really still dominant. So there is no change in the picture that the dollar has a dominant role. The euro is a trailing second, representing around 20% of use, and Japan and China are really lagging behind. A third indicator we can look at is which currency are countries using for invoicing. And this is actually based on some work from colleagues of mine together with Geeta Gopinath, where they've looked at through service invoicing patterns in global trade. Now, I think what you can just take from this chart is it's flat as a pancake, right? So on aggregate, we don't really see any movements here. But I told you already to start with, there are cracks emerging. And to look for the cracks, you need to actually look below the surface. I've looked very much at the aggregate data. So if you look a little bit deeper and delve deeper in the data, the first thing where you see a clear change in pattern is in FDI. So if you look at the blue line, the flow of greenfield FDI flows from the west to east, you can see there's been quite some decline in recent periods. Instead, there has been a sharp increase in FDI flows within the West and from West to neutral countries. And at the same time, if you look at earnings calls that are made with global firms, and you look at the use of the terms shoring terms, so nearshoring, friendshoring, onshoring, then you see a massive step up in the use of these terms. So Western companies are clearly friendshoring their production capabilities. Second, on reserves, as I mentioned, a lot of inertia in what actually reserve asset managers are doing. But in service, we see patterns that are shifting. First of all, when asking central banks whether they consider geopolitics as a major factor for reserve management in the next 5 to 10 years, in 2021, 20% of reserve asset managers ticked this box. But this has increased to above 80% in 2022 and stayed persistently at around 80% since then. Similarly, in the survey that was conducted in 2025, asking about the most significant risks facing official reserve managers, the two first ones are actually quite geopolitical in nature. It's concern about US protectionist policies and geopolitical escalations. Only thereafter came the traditional kind of indicators that normally reserve asset managers look at, like inflation volatility, interest rate differentials, fiscal policy, and growth outlook. Another indicator on the reserve side where we see that central banks are concerned about geopolitical developments is the accumulation of gold. It has reached record highs in 2022 and stayed at that high level since then. You can see that on the blue bars on the left-hand side chart. And of course, part of it could also have been explained by inflation, but inflation has meanwhile come down and central banks continue to accumulate those reserves. There was also some work at the ECB in the International Role of the Euro report 2 years ago, we're looking at which central banks are actually accumulating gold, and it's mainly those who are geopolitically closer to China and Russia that are behind this gold accumulation. Now, accumulation of gold could potentially still have some way to go. If you look in the 50s, gold represented around over half of the reserve asset baskets of central banks. By now, it's only 17%, so it's actually much lower. So we're seeing an accumulation, but we're still far from the levels we saw in the 50s. Now, there was a lot being said, and I just show this here as an aside, of gold actually overtaking in reserve baskets the euro on average across the globe, with gold actually representing a higher share this year than the euro. But actually a lot of it is also, the increase in the gold representation because the price just increased, so the value has just increased. If you look at it at constant prices, so you take, for instance, end 2023 prices, that's the middle bar, and even more clearly, if you take end 2021 prices, actually the gold is more or less on par with the euro in terms of global reserve basket choice. Some would say that gold may actually become even much more important, and why shouldn't we move away from dollar and the euro completely and switch to gold? But here, just a quick reminder that there are limitations to the gold as an official reserve asset. It has a volatile price. It doesn't remunerate. If you hold euros or dollars, you don't hold them in cash normally as a reserve asset manager. You hold a bond, and that gives you an interest payment. There are storage costs to hold, and of course, there's an inelastic supply as opposed to reserve currencies. Now, the third block to look at is invoicing. You remember the flat pancake there that we were looking at? Now, again, if you scratch below the surface, we do see some shifts in patterns when you look at country-specific developments. And of course, the strongest example you can look at is Russia's trade with China. So at the time of the invasion of Russia in Ukraine, actually most of Russia's trade with China was in what we would call sanctioned currencies, so that's the dollar or the euro. And you can see that if you look at the dotted line on the chart on the left, both exports and imports, more or less almost 0% was invoiced in non-sanctioned currencies. By now, that's around 30-40%. I realize the left-hand axis has, it's showing on the screen, I just don't see it there, has dropped off, but it's around 30-40%. Now, if you also look at those countries where we saw the largest declines in the share of dollar and euro for invoicing, then you can see these are countries that are geopolitically mainly close to Russia, basically, where we have seen these developments. Now, that raises the question, we see some cracks in the system, what's next for the global currency constellation? And just wanted to stress here a little bit the importance of good policies. Just a reminder of what makes a currency an international currency. I mean, and there's three important blocks. One is stability. So, for instance, having price stability, having a good macroeconomic framework. The second one is predictability, having rule of law. As an investor, you want to know where you stand. And the third one is liquidity, having deep and liquid capital markets. So it tends to be a large country because you tend to have bigger capital markets, right? Europe, for instance, is at a disadvantage with the US because we still have fragmented capital markets, right? But the US has everything in the recipe book that made it an international currency. It had very good, stable macroeconomic policies, very predictable, rule of law, and then deep and liquid capital markets. On top of that, it had the infrastructures that supported that. The financial infrastructures are a lot based in the United States. And all of this, if you have this as a currency, you have kind of a virtuous circle where you basically become increasingly important because others are using your currency. You are more likely to use that currency as well. And this, as a result, you end up with a hegemonic status of a currency. Now, for the dollar, this has been relatively unquestioned in recent period until this year. And in particular, after Donald Trump had announced some massive tariffs on the 2nd of April. And we saw some very unusual patterns at that moment in time. So normally, for instance, when a country announces a tariff, according to the textbook, you would see the currency appreciate. And that's actually what we saw until then. So the blue bars here, when they're in negative territory, meant that the dollar was appreciating against the euro. And we looked at separate events where there were tariffs announced, and you can see there was a dollar appreciation at that time. But on the 2nd of April, suddenly we saw a very different movement. We saw actually the dollar massively depreciating. And at the same time, when you looked at correlations with other financial variables, you can look at the co-movements by bond markets, with equity markets. You could see basically to what extent you saw a safe haven pattern or a flight from, because a country is seen as risky pattern behavior. So normally, what you look at when you look at countries, for instance, US, the Swiss franc, the yen, you would see a safe haven kind of behavior when there are shocks. Well, when there's a risk-off mode, money tends to flow into those countries and it tends to flow into their bond markets, right? And that's what you see in the blue bars for the US, the Swiss franc, for the dollar, for the Swiss franc and the yen. For the euro is more or less in a neutral side, because when we have risk-off modes, what normally happens is that money flows from the south to the north in Europe, basically. So it moves within the eurozone. But between April and more or less May this year, what you saw was a very different pattern for the dollar and for the euro, actually. So the dollar, instead of acting as a safe haven, actually money flew out of the dollar, although basically there was a risk-off mode. And money flew into the euro area and across the board. Yeah. This unusual pattern you can also see here in this kind of correlations between the dollar index, so the broad index of the US dollar, and 10-year treasury yields, which tend to move very closely together, and that correlation broke down in April. Now I should tell you that since then, the patterns have returned to normal in a way. So the question is a bit, was this a blip, or is this a precursor for more to come? We've had in the past also situations where the status of the dollar was questioned, where policies were put into question. One was, for instance, the Nixon shock, where the dollar always remained as a hegemon. And of course, there's large inertial forces that make sure that a country remains in an international currency, because there's network effects. So these movements tend to be slow and gradual. So actually only time will tell us whether we will see more larger and pronounced movements. And a lot will depend on the policies of the US itself, right? So the stability, predictability, and liquidity are important factors. If they keep those alive, then of course US has a good chance of remaining an important international currency. But there is one area where we're actually seeing some cracks emerging and where we're seeing actual movement, and that's in the payments area. Now, before I go into the evidence, let me first explain what I mean when I talk about global payments, and I'm thinking here about cross-border payments. So as a citizen, when you want to make a cross-border payment, maybe you live in South Africa and you want to make a payment to Thailand. What you do, you go to your bank, and the money is being wired to your counterpart in Thailand to their bank. You may be a bit more sophisticated, and you use a Visa, MasterCard, or even more sophisticated, you use PayPal or even a stable coin these days. Now, what you see as a citizen is basically the tip of the iceberg. What goes underneath the sea level is a very complex and wide network of correspondent banks and of institutions, of pipes, basically, that make sure that these payments can move. And actually, when you make a transfer from South Africa to Thailand, I'm almost sure that that money somehow passed the US along the way. I mean, what you see here in the bottom, you see all these abbreviations and names mentioned. One actually is located in Belgium and not far away from here. I'm not going to go into the detail of what each of these institutions do. I can point you to the Geneva Report, Chapter 3 this year, where there's a detailed discussion on that. But I want you to maintain two things from what is shown in this chart. First of all these institutions are Western-based. And second, for a long time, we never cared about this, and we were never interested in this. And the reason was they offered an efficient, well-functioning, safe system that was offered to the globe and that was integrated. And that's a good thing, because there's network effects, and if you have one system, it's much easier to move money across the world than if you would have fragmented systems. So the system functioned, and macroeconomists didn't look at it. We made sure that the operational risks were mitigated, but for the rest, it had no relevance in the discussions. Now, that significantly changed when the West started imposing financial sanctions and brought basically these payment systems into the financial sanctions sphere. And in particular, this came to the fore, for instance, when also foreign institutions were subject to sanctioning by the US if they were not observant to the US financial sanctions. And for instance, BNP Paribas was one institution that fell victim of that. What did it mean? It meant that the banks suddenly became very wary about transactions and had to step up their compliance and their checking. That makes these transactions more costly, and what it means is that for some countries, sometimes the corridors disappeared or became more costly or slower. There were also some countries that were, through de-swifting, for instance, some banks cut off from the international payment system, and all of this brought the attention to emerging markets to a dependency that they had on the Western system. Something, when it was politically neutral, let's put it that way, didn't matter. But suddenly they feel this may matter. And that this was relevant for them, you can see, for instance, in BRICS leaders' statements. So this is a textual-based analysis of leaders' communiques, and we're looking here for to what extent initiatives are mentioned on cross-border payment systems. A 0 means no mention. A 10 would mean immediate action, so a concrete initiative. So what you see on the chart is two things. First of all, there has been an increased attention to this, but it's mainly announcements. It's not yet concrete initiatives. Just to give you an illustration of some of these announcements, you can see here a list of recent announcements, and there has been really a step up in recent years. But you see mainly these are countries that are either under sanction or under fear of being sanctioned. As mentioned, concrete initiatives are fewer. Here are just some selected ones mentioned. Russia, Iran, not surprising because, of course, they had to develop alternatives. But one where I do want to point your attention to is China's cross-border interbank payment system. So that is a settlement, clearing, and messaging system. And basically, its take-up has increased quite a bit. So we're now talking about around 2 million transactions per quarter, which is on a value of around $6 trillion. Now, these sound amazing amounts, right? But don't let yourself be fooled. If you compare to that SWIFT, I mean, these amounts are dwarfed by that. So for instance, SWIFT connects around 11,500 institutions. SIP's only like 1/10 of that. SWIFT had 11.9 billion messages, for instance, sent in 2023, accounting for around 47.6 million messages on average per day. So whereas these initiatives are taken off, they still remain small. Now, does it matter? Well, there is some evidence of shifts in the use of settlement currency, for instance, in China, whereas in 2012, China's external trade, 10 to 15% was settled in RMB. By now, we're seeing amounts of 35 to 40%. So, of course, the flurry of initiatives are bearing fruit. One of them is the development of SIPs. There are, of course, many other ones that China is envisaging. Now, this is geopolitics. Another thing that's shaping the payments world is technology. Technology is really transforming the payments world. And one way is the development, for instance, of fast payment systems. Now, why do I'm talking about technology when we're talking about geopolitics? Because technological change may mean that countries can leapfrog the old systems, and so geopolitical fragmentation could happen quicker when you have these technological innovations. So at the ECB, with some colleagues, we try to understand to what extent geopolitics is already shaping the decisions in payments world. And with fast payment system was a good case in point to look at it. It's a new technology. It exists for more or less 1 decade. And actually, emerging markets have adopted it more favorably than advanced economies because of this leapfrogging idea. A good example is, for instance, PIX in Brazil. And emerging markets have also started looking at how they could interconnect themselves across borders. Now, if you do an empirical analysis, what we find is that actually geopolitics matters a lot in those decisions. And more, for instance, than geographical distance, which what your traditional gravity model would tell you. And believe me, we've cleaned up for all kind of effects and for endogeneity, but if you don't believe me, then you can also look into the paper to see the details. Now, if you want to see which the kind of interlinkages we have, you will see, interestingly, for instance, just an illustration of the current linkages that exist. Of course, Europe is very interlinked, but you have a lot of linkages in Africa, for instance, but also in Asia, Latin America has looked in terms of interlinking across borders. Another technological innovation is the DLT, so the distributed ledger technology. And that's also important in the payments world because stable coins at least pretend to be a good means of payment. They may also have a business case, in particular cross-border. I was telling you the systems were safe, efficient, fast, but actually with increasing compliance, but also compared to new technology, actually the systems compared to stablecoin are relatively slow. And there's a lot of work actually on the G20 to make the legacy systems faster. But the stablecoins can basically jump ahead of that. You can have instant payments at a relatively low cost. And so there may be a business case for global, for cross-border payments relying on stablecoins. And on top of that, the US administration has come forward and really pushing forward the use of US dollar-denominated stablecoins. There was an executive order by Donald Trump a few days after his inauguration. And now there's also a regulatory framework with the Genius Act. Now, one reason that is said why this is important for the US administration is that it's one way to make sure that foreigners would continue to buy US Treasury securities. And you can see that stablecoins is already a non-negligible player in that market, but of course still small compared to many others. Of course, at the same time, the potential could be very high. Now, as I say, stablecoins could offer some benefits in terms of global payments. It also comes with some risks. And actually, it reminds a lot of the pre-Civil War free banking area, so the late 19th century, when we had banknotes. Well, we still have banknotes today, but the name banknotes came really from banks that were issuing notes that were backed by certain reserves. And so a stable coin sounds very similar to that, but in the digital age. So what did we see at the time? There were regular bank runs basically on these notes, in particular when the holders were were unsure about the sufficiency of their reserve coverage. And sometimes that also spread over to better banknotes at the time. You could imagine similar scenarios with stablecoins. In addition, the concern can be, in particular, if the reserves backing our treasuries, that a run on stablecoins also means a run on the treasury market. So you risk basically having a stablecoin sovereign doom loop there, which could be very detrimental for financial stability. A second factor is that stablecoin transactions may be fast, but maybe they're also fast because you're just bypassing the Western payment infrastructure, and all the checking that we're doing for AML, for sanction respect, is maybe not there. And of course, the risk for illicit trade increases. And then finally, as money can flow very quickly in the technologically advanced age, with stablecoins, they can also flow very quickly across border, which is even more worrisome. So these are the risks from the stablecoins, but if we're thinking now about potential impacts of increased fragmentation in global payments at large, there's 4 factors I would want you to take home. The first one is, as I said before, the system that was integrated was good because it was integrated. If you see a system that's fragmenting, what does it mean? Making payments between those segments will become more difficult. It can cause delays, liquidity may not flow where it necessarily is needed, and also it can be easier to do money laundering or terrorism financing. The second one is we have currently systems that are very high in standards in terms of technical flaws. I mean, it works. You know, how often do you have really a payment interruption? It's very, very, very rare, right? But if you have new systems developing and the standards are lower, you could have technical flaws or you could have higher risks of cyber attacks. And actually, the risks for financial stability are enormous there because we're talking about quadrillions of amounts of money that are moving through those systems. The third one is we're using sanctions now as a deterrent in international conflict. Of course, if alternatives are developed, then of course the effectiveness of the sanctions is lost. And the final one is a question, can a change in the payments infrastructure be a precursor for bigger changes in the international monetary system? Normally, when we talk about changes in the international monetary system, there's a debate going on where it has never settled against macroeconomists whether changes in trade patterns precede those in finance or vice versa. But maybe actually payments could be a step 0. When I engage in a payment relation with somebody, it's a very short-term relationship. I pay you and I move away. So it's very easy to change infrastructure or structure. It's less costly. For a reserve asset manager, for instance, who is buy and hold, he thinks much more carefully where he puts his money. But maybe a change in payments can be a starting point and a nucleus for changes in invoicing patterns and changes in finance. So that's why it may be an area where we need to keep an eye on. So implications of a more fragmented world beyond the payments, right? So as I have shown you, the international monetary system today is still very immune. Some cracks may be appearing, but the system is only evolving slowly. But there is a risk when we think of theoretically about the fragmentation scenario that we have this multipolar currency order. And I mentioned at the start of my presentation that implies significant risks. Which are those risks? Well, you could have more volatile exchange rates and more uncertainty. You could have more disruptions in trade and investment flows. And in particular for emerging markets who are more vulnerable to external shocks, this is a source of concern. And of course, if a country loses its dominant status, like the US loses its exorbitant privilege, that could lead to higher interest rates in the US, and it could lead to a broader rebalancing of global savings and investment flows. So what's the way forward? Because this is all very pessimistic, right? But the best way forward, of course, is that we avoid these scenarios, and the best way is to continue to cooperate at the multilateral level. But what if your counterparts don't necessarily want to engage anymore in multilateral cooperation? So the first is to try to keep the momentum alive on global priorities with as many countries as possible, so establish coalitions of the willing. The second one is to make sure that the international institutions continue to maintain their legitimacy, so making sure that countries feel represented and feel included. And we need to make sure that tools for multilateral surveillance are retained, because risks, basically, and cross-border spillovers in this very integrated world is very large. The third one is to strengthen the ties with regional financial arrangements, because these are becoming more important in the fragmenting world, but we need to make sure they connect to each other, and the IMF can act as an important bridge. And the final one is statecraft measures are important as a deterrent, but we need to be careful and think when we want to use them. If we use them too frequently and not well justified, then of course countries turn away from our systems because they say, what's the logic and what's the rule of law that we're applying? In the area of payments, there are also some specific recommendations. I will just run through them at a very high level, and I'm happy to discuss them in detail. But one thing is to make sure that the interconnected global system that we have stays state-of-the-art. And as I say, they could be faster and they could be cheaper, and work needs to be done on that. And actually, the G20 has a roadmap for that. The second one is technological innovation implies that we need to keep up with those innovations, and that means also central banks need to keep up with these innovations. You want central bank money, which is the safest form of money, there's no credit risk there, to be the anchor. And so it should also be the anchor in a DLT-based settlement system. So central banks need to innovate to make sure that they can do so. And there's actually work going on at the BIS, but also at the ECB to make sure of that. Then the other thing is when you think of a fragmented system, even if you're fragmented, you would like that systems can talk to each other. So you need to have interoperability. So having similar standards are important. And here, for payments experts, the ISO 20022 is a very commonly mentioned standard. Surprisingly, even many Western countries still haven't adopted. And then finally, we need to continue to cooperate. If you think AML is important on countering the financing of terrorism, then we should continue to cooperate on that. And on crypto assets, it's important that we have at least some sort of level of global playing field. Now, my final questions. In this fragmenting world, are there opportunities for the euro? Yes, but it needs to be earned if we want to have more prominence. And we need to do our homework. And there's three levels where that work needs to be done. First is geopolitical credibility. Forging new trade agreements, but also rebuilding Europe's hard power is an important basis. The second one is economic resilience. Completing the single market, building the savings and investment union, reducing regulatory burdens, and having more safe assets. It's all about having that liquidity in the market. As I said, the US has a deep and liquid capital market. Europe has potentially would have the same. It's just that our markets are fragmented, so they're less appealing for international investors. And then we need to make sure we maintain our institutional integrity, respecting the rule of law, ensuring that we have the independence of institutions, and that Europe speaks with one voice. Very often when we talk about the international currency use, we don't talk about these factors, but because we're taking them for granted, but they're very fundamental when we're thinking about the international role of a currency. And with this, I thank you very much for your attention, and I have here the links to 3 reports and 1 speech of my president and 2 reports that I contributed to that I can point you to if you want to learn more. Thank you.
Thank you very much, Isabel, for this very comprehensive presentation. There are lots of takeaways from what you said. We have 3 discussants who may now express their views on what you said and also on the subject in general. I will not present them in as much detail as I did for you, but I want nevertheless to say first of my friend, the first discussant, Christian Guimers. He is a professor of international economics at the ISHEC Brussels Management School, and he's vice chairman of Robert Triffin International. He is also president of IRELAC, an international link between European and Latin American and Caribbean universities. He is specialized in international monetary issues, regional integration, and of course, Latin American policy issues. He has had a distinguished career in the European Commission and has been seconded to the Joint Vienna Institute, to the ECLAC-CEPAL United Nations Secretary in Santiago, and he has been teaching in several universities. So, Christian, what is your reaction to what Isabel has been saying? Give us also a Robert Triffin point of view.
I need my PowerPoint.
Yes, there
it is. So, thank you to Isabel and to Bruegel for this nice opportunity to discuss these important things. I have very few things to add because I share most of the points that were brilliantly presented here. However, I have 3 points where we would like, as Robert Triffin International, we would like to go much further than what was presented. The first aspect is, maybe it looks a nuance, but it's very important for what is coming now as a threat for the euro and for most of the currency in non-dollar area, which is the emergence of the stable coin, especially, I would say, the Trump stable coin, which is really a threat for monetary sovereignty and the efficiency of monetary policy, because this is really a danger, putting into question the basic two-tier structure of money. That means the fact that we have central money and deposit bank money. With stablecoin, there is a mixture risk, which impairing what is the so-called singleness of money. Maybe we'll have the opportunity to discuss this very important concept for understanding what is money. And the Trump stablecoin especially is a privatization of the dollar. And it could, even when you assess the potential size of the dollar stablecoin, this would be the scam of the century, because some vested interests could make in a few years tens of billions of dollars for their pockets without presenting any value added, because all that could be provided much safely with the CBDC. This is also an issue for discussion. And the other danger is the increasing domination of the dollar, and precisely because the dollar stablecoin is directly a worsening of the Triffin dilemma. It is about to absorb more world savings, especially savings from emerging and developing countries, impeding decarbonization. This is one of the points that in RTI we developed a lot. And for us, the genuine answer would be CBDC. Unfortunately, we are still waiting for the digital euro, which would be in reality a way to be protected from the Trump stablecoin. So what we propose as RTI is to use, as a second best, to use the opportunity of issuing stablecoin, but to do it in SDR, in special drawing rights, because this is a way even to promote the euro, which is almost 30% of the SDR, and this would protect the singleness of money. Maybe we'll discuss it. And with this, I come to the second major point, which is the issue of the multipolar currency order. I have the feeling that ECB gives the impression that there is a linear trend from invoicing and payment in less dollar towards a multipolar currency order. In RTI, we consider that this would be a catastrophic evolution because it would create a systemic instability, not just in exchange rate, but also in the possibility for central bank to control their monetary base. The main reason, the systemic reason, is that going from the dollar to, for example, tripolar or even more key currency would not resolve the main flaw of the present system, which is the fact that this remains national currency used for international purpose. So this is destroying the singleness of the international money. Presently, the dollar is, although imperfectly, fulfilling this singleness of the monetary base with essentially the USD bills. But what we need is a multilateral way to respond. I give an example. To be a key currency, like the dollar, would require the capacity to issue a safe asset and to become, for example, the euro area would become an important net debtor, like the US. And there is no place in the world economy for having China, the euro area, and the US in deficit. There is no space for that. So it is an impossibility to have a stable multi-currency order. And I am sure that neither the ECB nor the People's Bank of China would like to feed an external indebtedness like the US. So for me, this is a logical impossibility. And the objective of the reform we very much need is to be in condition to issue safe assets, which are not the debt of a single economy, but for example, with the SDR, we could have a more balanced repartition of the flow of the system. So at the global level, monetary stability requires both, as we did since last century or the 19th century, the possibility to have the singleness of money. We reach to do that at national level, and we are still unable to make this at the international or multilateral level. We don't have a single monetary base, except for what the dollar has fulfilled up to now, but more and more imperfectly, especially with weaponization of the dollar. So there is a real danger that we could go into a chaotic situation. So my third point is the fact, as it was mentioned in your presentation, the fact that the regional monetary arrangement could provide a genuine opportunity to try using the financial dynamics of the market to issue in private SDR or in private stablecoins, so to use the clone of the official SDR to issue this by private companies or banks, and to create at regional level a common standard which would be the same. The SDR is a universal way to issue safe assets. And in that case, we could have a common standard for making a lot of inter-regional transaction and clearinghouse. This would be a way to bypass the fact that at the IMF, the official SDR is still blocked and freeze. So we could do it using the financial dynamics on the market for having a common standard. So I will stop here.
Thank you very much, Christian. Thank you very much, Christian, for developing particularly those three important points, which I think are complementing what Isabel said. Now I would like to introduce Peter Pratt. In fact, no. He has decided you go next. And Peter, okay, I don't think it's necessary.
I don't care.
To
No, but you told me I would be the last one, so I didn't prepare much. So no, please go. Yes. So you want to introduce me?
Well,
yeah, good.
Everybody knows you, but of course I can remind people that you played such an important role in the European Central Bank as member of the executive board and as a chief economist. And remind the people that you got your PhD in economics at the Université Libre de Bruxelles, that you worked at the IMF, that you were chief economist of the Générale de Banque and Fortis Bank, that you were chef de cabinet
before the
for
collapse,
the
I
Belgian
tried to
Minister
say,
of Finance
before the collapse.
from 1999 to 2000. and of course that you were executive director also at the National Bank of Belgium with many important responsibilities, and that you have served in several high-level international bodies, including the Basel Committee on Banking Supervision,
it was
the
Basel
Committee
II,
on Payment and Settlement Systems. So you are surely very well placed to talk about the danger of financial fragmentation.
No. I mean, thank you, thank you very much. Listening to all this, and Isabel Swift. That was my first experience really with geopolitical issues, where the US subpoenaed the SWIFT, I don't know how to call it, branch or whatever, mirror of SWIFT Belgium, SWIFT Europe Belgium. And they spied, they subpoenaed SWIFT, and they got the keys, to read the messaging. And that was kept secret during, I think, 4 years. So I was really in contact with Treasury, with CIA and these people at that time. And they could trace, actually, after the Bali terrorist attack, they could trace and find the terrorist, actually. So I lived this episode well before all this geopolitical weaponization of finance and all that before. And there was really something where, when it came out in the New York Times, it made the headlines and it created reactions in Europe, especially it came from Germany, protection of privacy and all that, and would the US spy other things that, for the purpose of tracking terrorists and all that. So there was a very interesting thing, and there were solutions to that to try to fence different geopolitical zones from the SWIFT environment. And the system continued, but of course some of the countries like China and Russia took notice, of course, of that, and started to think about, how being lesser dependent of the infrastructures in payments, in this case, that you mentioned. So that was my experience with that. The other experience that came to my mind was, of course, the global financial crisis, where indeed that was the case of, I have Euroclear, by the way, Euroclear also in Belgium, which I was one of the overseers at that time. And when, Lehman Brothers in the weekend collapsed, we had in the G10 network, at that time was the G10 conference calls. It started with Australia, how did the market, open, and basically our colleagues from the US were saying we couldn't reach an agreement on Lehman, so it's going to collapse, so be ready. That. All to say that in this international environment that you describe, trust, simple trust among people is key. I mean, it's absolutely key. And when the US were very open and say we didn't succeed, in finding a solution for Lehman, you have to be ready. And then you get the contacts, what do we do with Euroclear when they open in the morning, and all this network this in the global, finance worked, I must say, pretty well for the infrastructures, payments infrastructures and all that. You had another example with the Lehman Brothers, where trade finance totally was frozen. And then the international cooperation suddenly, was fantastically active and all that. So there are also bad things, of course. We signed a lot of MOUs, what I learned in the crisis, memorandum of understanding, so where you deal with your colleagues from other jurisdictions. And when the crisis is there, M is me and U is you, okay? So a lot has been done in cooperation, worked pretty well, but there are limits to that. So that's my first comment. So, but we learned a lot from that. But at the end of the day, it was always, well, we are colleagues in a way, we are in the same boat, and we have to find somehow solutions to the problems we have. Now I'm not so sure. So let's go. So Kindelberger, to quote another, friend of global system, said, you need a sort of benevolent hegemon. That's the US defense. Well, it's enlightened, we call it enlightened self-interest, Now, I mean, that's a Western view, of course, because enlightened was meaning that the US would defend free world, values as they conceived free world. Many in emerging markets didn't see that as a benevolent, of course, hegemon. But it is true that in the West now, this is really a shock, what has happened. I mean, this is a shock. So are we going from a benevolent hegemon, defending free world values, to a malevolent hegemon, which has huge implications? That's why I start with crisis cooperation from the beginning, because if you say America first, how will it work, in a crisis time? Okay, so that changes the mindset of people, of course. Next point is, of course, you said Isabel, and I'm very happy to sit together, and because we were working actually together to prepare the governing. You mentioned that the monetary policy meetings, and Isabel was the collaborator, bringing input, and there was not an easy job she had, and she did it perfectly well. That explains the rest of the career of Isabel. But so I'm happy to be here with her. But when you look at, she said, the international monetary system is largely immune to geopolitical fragmentation so far. You said, of course, there are cracks, and all that. But so far, of course, Tina, there is no alternative. So you say, okay, we suddenly realize, and I will tell you something. We suddenly realize that the dependence on the dollar is absolutely incredible. It's something we knew more or less, but it's, when you think about, it's absolutely incredible. And now the Triffin dilemma, which I think a very interesting point, is that we always link that there's a demand for a safe asset in the world, the dollar, so they need to have deficits. But when you look at the dollar dependency and the role of the dollar, and you accumulate all the US deficit on the current account, I mean, it's a totally different magnitude. So the elasticity, this is a key point, the elasticity of the global financial system to dollarize finance is out of proportion of the Triffin dilemma, which would mean that the US would collapse very quickly because the demand of dollar is so big. You'd run huge current account deficits, and at some point then, and treasury, of course, public deficit, and then it would collapse very quickly. We had it in 71, but it's amazing when you think. And then I look, of course, a lot, of synthetic dollar, development of synthetic dollar, because global dollar liquidity is synthetic today. So it's basically, if you borrow in euros and you want to lend, in global market in dollars, you would swap. And I don't want to explain it here because we don't have much time, but reading the BIS documents, despite of its scale, dollar swap, and we talk about $100 trillion size notional value of swap market, 100 trillion, okay? It's huge. Despite its scale, however, the swap market remains poorly understood, leaving several fundamental questions unanswered. Thank you very much, the BIS, to telling me that. And it's true that when you start looking at that, you say, how is it possible that the dollar is so strong with such no dollar crisis, actually? And when that episode, because it's like a pyramid, you start with a tiny piece like money creation. I know you have written on this, Christian. And then you see the role of the dollar, how it was magnified through what? The global financial system. Yeah, but what is the global financial system? It's basically a handful of very big banks. We talk about not even a dozen of banks in the world. Global banks, which many of them, most of them are US banks, of course. Okay, so that's a reflection. So I think the Trump shock, the first one is Tina, there is no alternative. But the other one is, wow, this is like a cobweb, you cannot get out very easily because it's a construction which is there, and if you touch something, it's not so easy. So you have to invest, as you say, in alternative infrastructures you would do in a computer system, to fence different parts, that if one piece collapses, The other parts will continue to function and all that, which is, by the way, very costly when you think about. So there will be a cost to all this, so we shouldn't. But when you think about all that, how you can get out of this sort of cobweb, it's not so Tina. It takes time, but people have noticed. It's a strategic priority, certainly in China, in Russia, of course, and many emerging. Think about Saudi Arabia and many of these countries. And that's in that sense, when you think about the plumbing, infrastructures, I mentioned SWIFT, Euroclear, Bank of New York, the big custodians. Immediately what pops up is, of course, the world of sanctions, the weaponization. If everything becomes a weapon, tariffs or many things become a weapon, then of course, immediately you conclude that if you want to play a role in a geopolitical environment, you need to have a political body behind the currency. So can you have a monetary union in Europe without having a political union in that sort of environment? I must say, I'm not so sure. Yeah, of course, you can be a marginal regional power. But it's impossible if in the world of geopolitics not to have a very much stronger political union in Europe. So the single currency without political union for me becomes something doubtful in that sort of environment. Now it's very complex because Europe is growing and growing and growing in number of countries. So we may have Montenegro, why not? But it is clear that when you have a currency which covers 27 countries, and these countries do not all agree, on political priorities, it becomes, for me, I would say, we have this challenge from the US. We have in Europe lack of cohesion. I don't see so we have to continue to do what you say, infrastructures and all that. But so we are going to be in that sort of environment. Now, the last point on the US, it's TACO. Okay, it's a Trump, of course, gives a lot of contradictory messages, of course. So for example, I noticed that he said, if we lost the dollar as the world currency, that would be the equivalent of losing a war. So at the same time, they give message that we are free riding on the dollar. So the exorbitant privilege for them is free riding. So we want to make you pay somehow, don't know exactly how, but we want you to pay for that. But we want to keep our privilege, of course, at the same time. And there are huge fundamental contradictions. And so they come with a stable coin. So I would not be so worried of the stable coin. I think indeed we have to have a euro stable coin, SDR, you say. It's private, so for the time you need regulation, and all that. But you can do it with SDR, you can do it with euro. I think for me it's much more priority to think about this than about the CBDC, which the retail. I'm not talking about the wholesale CBDC, but the CBDC I personally not. Well, I think it's good to take, but that's not the revolution probably. But the question here will be on the stable coin issue, and I agree with you. I don't think the US are going to dump necessarily enormous amount of treasury bills. There will be other safeguards, against excessive deficits in the US. And basically, if a stable coin, if interest rates go out, people go from stable coins, they will go to money market funds. So there will be some substitutions between money market funds and stable coins. Of course, if the world starts using stable coins, it's a different matter. But we are not yet there. We have some time to do. So the bottom line, I don't know. The bottom line will be very complex to de-dollarize and getting out of this. I'm worried. Yes, maybe Jérôme, the dilemma of Hélène Rey is also an interesting point to bring in the discussion, because monetary policy, the Fed policy, is absolutely of huge importance for the global financial cycle, and the mandate is national, of course, for the US. Of course, they take the spillovers, the spillback into consideration when they set, but basically it's a national mandate. But, and I really conclude with that, but they support the backstops, the liquidity backstops, and they act, to preserve all the liquidity conditions in the worst case. So it is true that they have a national mandate in monetary policy. They look at spillback, but they also supported, and up to now, backstop, as you have mentioned that. And that remains a big question. The responsibility to ensure orderly liquidity conditions in case. There's a lot to say, of course.
Okay.
Thank you very much. I think you want to react immediately to...
No, I think I want to take back the chairmanship at this point because we need to wrap up, and I don't think I need an introduction. Right, exactly. So basically, at this point, we are essentially in negative time because we do need to leave some room for reactions by Isabel and a few questions. And so I'm not actually going through my comments. I'm just going to tell you what I would have said. So I would have made 3 points which are roughly consistent with what Peter said. First, we are really in big trouble in Europe, and we are in big trouble for two reasons. Both related to dollar dependence. So one is that, regardless of whether the US is malevolent or not, the dependence on the dollar as a safe asset is a much more dangerous thing these days because the United States is in a fiscally unsustainable position. And while the cracks that Isabel identified in a backward-looking way have been gradual, there is a distinct possibility of a very sharp widening of the crack as a result of a fiscal crisis in the US. And then particularly depending on how that is managed, whether that is managed in a discriminatory way or not. But the one event that could really lead to a very sharp acceleration of fragmentation in the sense that the reserve asset role of the dollar suddenly declines is a fiscal crisis, and that is quite a conceivable, plausible situation these days. Invoicing currency is harder, but to get rid of safe asset status is quite easy and plausible thing, number one. Number two, I do think we have to do better at protecting ourselves in Europe from both coercion and from our dependence on the dollar as a safe asset. And I think there are two things which we have to do more actively. One is to develop a euro-based safe asset, and the second one is indeed to develop payments systems that are less dollar dependent. On the euro-safe asset, unlike Christian, I do not think that this would create a Triffin dilemma for Europe. I think the fundamental, distinction is between gross and net holdings, right? So if we produced a large-scale euro-safe asset, yes, there would be large-scale demand for that, so there would be an inflow. But that means there would be a gross position that would go up in the euro area. So we would have a gross liability to the rest of the world, but we can then decide essentially how to invest this money. There could be a matching outflow into riskier assets, right? And this is essentially also the argument why the MAGA crowd is wrong in claiming that there's a causal link between safe asset status of the dollar and the current account deficit, right? So safe asset status of the dollar is everyone wants to hold treasuries. It doesn't mean everyone wants to hold US dollar denominated assets, including risky assets, right? So it is up to the US how it then wants to reinvest the inflows that it receives for producing these dollars and whether there's an equivalent outflow or not. So this is the basic point made by Henry and Pierre-Olivier Gourenchas, and comparing essentially the safe asset status of the dollar or the function of the dollar to a hedge fund. So you are, you take on, you get leverage, but then you reinvest in riskier assets. That involves an exorbitant privilege. People trust you as a safe asset, but on the other hand, you provide an insurance function to the world, because if there is indeed a flight to safety, then your currency will appreciate it, which means that you suffer a loss, right? And so these things match each other, and it's simply not true that the inevitable counterpart of a safe asset status is a current account deficit. So we should do more to promote ourselves as a safe asset. How do we do that? I think that given that we cannot do it at the central level by generally creating very large sort of common debt issuance, we probably have to revisit some of these so-called synthetic safe asset proposals of the last decade, which essentially means that we create a public intermediary that will buy bonds at the national level and then issue multi-tranche debt as common debt, of which the senior tranche would be the safe asset. So I think this is an idea that is worth revisiting. And then the final point on stable coins and CBDCs, I mean, I do agree with both of you that, you know, this is a big threat. Essentially, the US is actively trying to promote US dollar-based stablecoins because they are a source of monetary financing for the US, and that will increase our dependence. So what can we do about it? So I do not think that SDR-based solutions are in line with the spirit of the times. They would be very difficult to pursue even in the best times of multilateral cooperation. So I do think we have to essentially choose between a much more ambitious version of a CBDC or promoting euro-based stablecoins or some combination of the two. And so here's an idea, which is, you know, we might, if we want to remain close to the current version of the digital euro, we could do so in the sense that this is mainly an instrument for euro area retail. It's not a wholesale euro, it's not for international currency, but we should, at the very least, to make it, you know, truly a backstop, eliminate the artificial holdings of the maximum of the wallet, and instead introduce a fee on a sliding scale, right? So, for example, your first 3,000 euros would be free of fee. If then you want to have an even bigger digital euro holding, you pay a fee, and so what this would, so this would be number one. Number two is to make sure that these euro-based stable coins are really safe. I think you want to both regulate them and give them access to liquidity support by the ECB. And so I think if you do that, you still give banks a chance to either issue stablecoins themselves or to tokenize deposits, because the essential feature is that since you are charging for large holdings of the digital euro, you're not outcompeting the banking system on price, right? So that there is no crowding out of private payments technologies through the ECB. And in a system like that, you could see, presumably, some competition and coexistence of CBDCs, euro-based stablecoins, and tokenizations of deposits. So this is where I would go. So those were my comments. And now I think what I suggest is we first give the word back to Isabel, and then we will run over, since we have, you know, locked you in here by offering you alcohol at the end of this. We'll run over about 10 minutes, and I will take 3 questions, but no more, and we'll go back to the panel. Isabel.
Okay, so you're telling me I'm standing between the audience and alcohol now.
Yes, that too.
So thanks a lot for all the comments, and I think, Jeremy, you sent a few things that I was going to say about the difference between gross and net flows, and actually if you look at the dollar in gross terms, its role is much more substantial than what you would see in net terms. And that's what I say, if you're moving money across the world, for instance, South Africa to Thailand or wherever, it has passed through the US. And so you don't see that in the net flows, but you see that in the gross flows. And this is where, through these infrastructures, the dollar really plays a predominant role. I mean, I agree with Peter that moving away from the dollar is very, very complex, given how the system is so reliant on the dollar and so dependent on the dollar. So I don't think it's something that can happen overnight, and it's something that will happen over a long period of time. But what you see is in the payment side, for instance, is that initiatives are starting to take fruition, and that will take a long time. The question is whether this will actually materialize, and a lot of it is the onus is on the US itself as well, because if they continue to offer a stable, predictable, and deeply liquid market, then the cost of moving is going to be too high, right? But if, of course, the US is not predictable and is not stable, as Jerome says, worries about US Treasury market, for instance, then, of course, you know, you prefer to move to the other system because the cost of staying in the dollar-based system becomes too high. And I think there was a nice work by Mark Sobel and Steve Kamen where they, actually before Trump came in the administration, wrote something on the international role of the dollar, and they said, Actually, if the international role of the dollar declines, then the US should be worried about much more than just its international role, because it has massively messed up somewhere along the way. And so I think this is very valid. The discussion on stable coins, I think you can have a whole session on that on its own right, so I'll be very short. But I think stable coins are a big concern for emerging markets. If you are in Argentina, would you rather hold a dollar-denominated stable coin on a peso? I would know what I would choose, and I'm sure most Argentinians would know what to choose as well. If you're in Europe, that choice is not so obvious, right? I mean, you would much rather hold your euros. Why would you hold this dollar-denominated stable coin? So the concern is less. So what is it in Europe? It's going to be a means of payment, right? But what are consumers going to go for? The thing that's easiest to use, right? And we already have quite easy technologies. So it's not so clear that the stable coins are going to penetrate our domestic market. Where I see that stable coins have a value is on the cross-border segment, right? But the role of the central banks remains important, because if you have a certain stable coin, you hold a Circle stable coin, and you want to move to Tether, actually what you need to do is you need to go to hard currency again and then move to the other stable coin. So these environments are very segmented. So if you want to have an environment with stable coins that functions well, you actually need to have an anchor that makes sure that there's convertibility. And that anchor is always going to be central bank money. And I say there's a role for central bank money on the DLT. We're talking about retail CBDC, but actually more importantly even is on the infrastructure side, on the wholesale side. And that happens under the below the sea surface in a way. So that's not what you see as a consumer, but that if these payments happen, that they can happen seamlessly on the DLT, also through the central bank, basically. So I think that's something important to mention. I'm just looking at some other parts. Yes, Peter, you're right that some parts of the financial system are poorly understood, and that's very worrisome, because that's why we always have the sources of financial crisis coming from those poorly understood parts of the financial systems, and definitely the swap markets is a big one. And then finally, on your point on US and TACO, I think this is the whole point about predictability, where the US is really becoming more difficult to understand, and that's bad for investors, and that's bad for the dollar, basically, in the long run.
Super. Thank you, Isabel, also for being so concise. So we have time for a few questions. Yes, a gentleman on the back. Okay, both gentlemen in the back, in the order in which they're sitting to me, and please introduce yourselves.
Thank you. I'm Vasilis Psaras. I'm a policy analyst. My question goes to Isabel on your conclusions about building the SIU. And it relates, as we are macroeconomists or something, or we have our experience on this topic, on the Feldstein-Horioka puzzle. When you hear about the SIU, you hear about moving savings and keeping savings into investments domestically. Is it possible that if we do that, we might become, from a force of integration, a force of fragmentation, and ultimately use our own hands to take out our eyes?
Okay, let's collect. Please introduce yourself.
Thank you for taking my question. I'm Bruno de Backer from the National Bank of Belgium. My question relates to Triffin and his famous dilemma and the Trump administration. So if you read Stephen Myron, the goal of the one of the goals of the Trump administration is to reduce the current account deficit, and there are two main ways for doing that. There's tariffs, and there's a lot to say about whether that is a good idea or not. A second way would be to devalue or depreciate the dollar, and that's kind of hard to do while maintaining the global currency reserve currency status of the US dollar. So do you think that it will be possible for the US administration to reduce or shrink maybe to zero the current account deficit while maintaining global reserve currency status for the dollar? Thank you.
And that was a question for Isabel or for Peter Pratt? I recommend Peter Pratt to answer that question.
Yeah, Isabel, but I'm happy that anybody jumps in, because that's kind of a hard question.
All right, please go ahead, and then finally Ivo. Yeah.
Yeah, hi, Ryan de Bok with UBS. I see there's like global markets in the title, and I was curious, if you look at equity markets, we have a massive rise in concentration. US equity markets are just dominating. I wonder how you think about what's happening in the equity market.
Okay, and finally, Ivo, you have the last words.
let's say I wanted to go further on the issue you brought with the fiscal problems of fiscal sustainability in the United States. Now, how would the United States be able to solve the fiscal sustainability problem? And traditionally, one of the ways is financial repression, inflation. Are there here dangers for this?
Is that question for me or for... Isabel is not going to answer that question. Okay, we go... why don't I start with you, because Isabel, because then you can punt on anything you want to punt on and hand it to us.
So SYU and the context that is presented here, it's really when you talk about an international currency, so it's about foreigners holding basically your assets, right? And so having deep and liquid capital markets make it easier for foreigners to want to hold that, because it's easier to sell and buy, you have sufficient supply of it, you have sufficient access. So having a more integrated capital market would very much help in that regard, right? So, you know, I don't want to single out special economy, but if you have Estonian bonds, it's not so likely that somebody wants to hold this as an international investor. But if you would have a big Euro bond market, then you're much more likely attracting international investors. In terms of whether you're having more savings, you know, going abroad or not, I think you need to also look at the other side of the equation there and look and basically at your savings investment decisions more broadly. And there, you know, you can have a discussion about the role of your capital markets union on that, but that goes far beyond. That's about fiscal policy and other domestic policies as well. On the point from Stephen Miran, I mean, there's a lot of contradictions in those proposals, right? So you want to reduce the current account deficit, but at the same time, you want to see more investment on net flowing into the US. So, I mean, I've always learned that the current account is the inverse of the capital account, so somehow that's an equation. It doesn't add up already there. On the question on actually tariffs, what it does to the current account, I think there's a lot of work that really shows that it reduces the gross flows, but not the net flows. So there's not going to be a very successful policy in terms of reducing the current account deficit. In terms of the proposal to devalue the dollar, well, actually the US administration has very well achieved that with their tariff announcement, but not in the way that they want, right? So can you do that while at the same time having that happening while not having a loss in confidence in the dollar? Well, if you would have responsible policies and you believe your dollar is overvalued compared to what you would think is a fair value, you may achieve such a thing, right? But it's very difficult otherwise to orchestrate something like that. On the question on equity markets in the US and the concentration, yeah, because everybody is just excited about AI, right? And that's then, you know, all the money flows where people hope at least you're going to see the productivity gains coming from in the future, whether this is the case or not. If I would know, I wouldn't be working at a central bank. I would work in private sector and make a lot of money. So.
Peter?
I think for me, I don't know the answer, but the question, the demand for US, you know, safe asset, the consequence of that, you know, world demand means that the US have to continue to run deficits, you know, and basically fiscal. So your question is, if they really squeeze and cut their deficits, are they going to create, you know, a dollar crisis in a way in the world, shortage, you know, of a safe asset in the world? I don't know the answer. My point was basically the observation that the elasticity of the financial system in producing, in responding to the demand for dollars is amazing, incredible. So my conclusion would be, yes, I mean, you have to see monetary policy, how you do this reduction of the current account deficits. But I think that there are private sector substitutes, you know, AAA companies where they can borrow today cheaper, some of these companies cheaper than the Treasury today. I mean, you know, there are a few examples, not many, but there are a few examples. And so I think the private sector will be very creative. I think if the demand is there, the US cut the deficit. And on the other hand, as you said, I mean, if the US have better policies, trust in the dollar will increase, and it means that the private sector creation, the problem I have, and that's why I quoted this BIS study recent, is that people say we don't understand really how that swap market works in general. 100 trillion. 100 trillion, I mean, market. And you know, I mean, the BIS publishes a lot. Yushin, you know, has published a lot on this. Claudio Borio, who left, I mean, I think it's very important reading to do and to try to understand that. But for me, the synthetic markets, dollar market, makes the crisis, you know, that Triffin was predicting a bit redundant. You know, it pushes. No, it may come at some point. But you wrote on this, yeah, the huge expansion of dollar liquidity, synthetic.
Okay, Christian, please.
I agree fully with what Peter reminds us. In fact, in RTI, we don't believe that the dollar is over. On the contrary, because our interpretation today of the Triffin dilemma is in fact the scarcity of dollar safe assets. And we have not enough safe assets. But the cost of the Triffin dilemma is the financial instability and macroeconomic instability on the world. And this cost is very huge. But I don't think that the dollar is about to be reduced in its fundamental monetary function. On the contrary, the Triffin dilemma, as you mentioned with the swap and the dynamics of financial market, is able to make the dollar as safe asset too scarce. With the cost of instability, this is why we promote a use of the SDR, because the SDR is not to suppress the dollar. On the contrary, SDR is more than 40% of dollar, and the dollar will remain the main vehicle. But in using SDR is a way to rebalance the risk and to absorb part of the contradiction of the Triffin dilemma.
Thank you. So to answer Ivo's question, so US debt is on an explosive path. It's a problem that's relatively easy to fix. You just need to raise taxes. And you know, the tax ratio is fairly low in the US. They don't have a VAT. It's not a problem, economic problem. It's a political problem. And if there is simply no political majority to do this, you know, in the next 5-10 years in the US, maybe at some point markets will get nervous, and then the adjustment could happen really quickly, because then the dollar loses safe asset status, and then the value of the dollar as a store of value and a means of liquidity would suddenly collapse, and that would lead to a very sharp increase in yields. And then the fiscal adjustment that you need, given these much higher yields, to make the debt non-explosive is indeed too high, right? So that is the scenario. Now, the question is that what would happen then? Would there be a default? Would there be inflation? That's anyone's guess, right? And so there would be a very sharp liquidity crisis in the first instance in the US. The Fed would probably intervene to stop that, or the Fed may intervene to enable a rollover and to stop the treasury market from freezing. And that might lead to big-time money creation and eventually inflation. So that's one possibility how it will bear out. But you know, in a technical sense, it's relatively easy to fix. It's not, US debt is not unsustainable. It's the current US fiscal policy that is unsustainable. But that might be eventually become an unsustainable debt problem if markets simply give up on the ability of the US to adjust. So those were my comments on that, and thank you so much. I hand back. I'm not you know, sufficiently RTI to give the final words, so this will going to be back to Bernard.
Thank you very much. Thank you very much to Bruegel. Thank you very much to you, Isabel. I think we should just go back to your very first slide and where your quotation from Robert Triffin, that the survival of the international monetary system, I would say also our global survival, depends on the willingness of nations to cooperate and to recognize the interdependence of their economies. And I link this to a word that was used by Peter, which is trust. Trust is absolutely essential to ensure cooperation.
Trust is broken, no? That's what
But precisely.
Don't depress us even more,
Yes, fragmentation is destroying trust, and we need agreed processes, standards, and institutions. That's why Robert Triffin International will always stand for multilateralism, which currently is in high danger. Thank you very much.